Hey everyone, Sofi stock soared after reporting earnings and then in the days following has come back down. So what's going on with Sofi stock? Why is the stock price whipsawing up and down? Well, I'll try and provide some explanation on that in this video here, going through the company's conference call and highlighting the key financial metrics, the key business statistics that are making the difference in Sofi stock. So follow along and let's take a look at these numbers.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so in the company's most recent conference call, CEO Anthony Noto noted that the company reached GAAP net income profitability in the fourth quarter and are positioned to continue to drive positive GAAP net income in 2024. That was great news. Not only did they achieve positive profitability in the Q4 for the first time, but they're also saying that this is going to continue. It wasn't a fluke. It wasn't a one-time thing. Profits are going to continue for all of 2024. So that was great news. That led to the initial stock price jump in the aftermath of this report. For the full year, net revenue increased by 35% to a record of $2.1 billion. Total members and products grew by 40% with 2.3 million new members in 2023 and a total of 7.5 million members for Sofi. Although what the company is not mentioning here, and I think it's important, is how it's attracting these new members. Sofi is spending aggressively to attract members, aggressively, and that can't be understated enough. If you look at Sofi's best-in-class APY to attract customer deposits, you can understand why these deposit growth, these membership growth rates are not all that impressive when you consider what they're having to pay to attract these customers. You think about banks like Bank of America, Wells Fargo, Citibank, JP Morgan, they're not paying hardly anything to attract customer deposits. They're just getting customer deposits and they're retaining most of their customer deposits despite not offering very much to those deposits. People are leaving their money in those banks without receiving very much in return. Now, that's not so good for customers, but for the bank, that means it's very lucrative because they're getting this money essentially for free and then making loans, and that net interest margin is much wider. And Sofi not expecting those kinds of net interest margins because they're having to pay so much to attract customers. Still, it is working. They are attracting customers. You saw that here, 2.3 million new customers added in 2023. And so the strategy is working. However, if you look out 10 years, is it more cost effective to spend all this money paying out customer interest on deposits to attract customers to stay with your digital first strategy? Or is it more profitable to open physical branches and generate customer deposits? Because when you have a physical branch, people just walk in and deposit money because you're a part of the community, you're the local bank. They look to that local bank, the one that's walking distance from their house, the one that's a couple-minute drive from their house, and they make deposits in that institution. So it's going to be an interesting comparison here, which strategy will win out. Now, legacy banks like JP Morgan and Bank of America, they've actually doubled down on the physical branch strategy. They're opening more locations now, and they're saying that it's been working really well, that when we open a new location, that return on investment has been really good. So it's an interesting, different strategy to consider here and see which one works out. Total deposits grew by 11.3 billion in 2023 to 18.6 billion. And over 90% of our consumer deposits are from direct deposit members. Now, if Bank of America or JP Morgan or Wells Fargo or any of those banks that offer 0% were to report an increase in total deposit, it would unequivocally be good news because investors know they pay close to 0%, so deposit just means a lot more cheap money coming into the bank. But for Sofi, that's $11.3 billion that they have to pay over 4%, closer to 5% now, yield on that money. So that's $11 billion that Sofi is paying interest income on, nearly 5%. So it's not all good news. If the company can find lending at a higher interest rate than what they're paying for these deposits, then it is good news. But it's not unequivocal good news like it is for banks that are paying 0%. The tech segment has been one that investors have been enthusiastic about for SoFi Bank. The tech platform segment revenue grew 13% year over year, and management expects this to accelerate to 20% next year. Still, this segment is growing slower than the rest of the business. Although if I was a SoFi stock investor, I would like to see the tech segment grow faster than the rest of the business, because the tech segment comes with significantly less risk than the other sides of the business, right? When they're making loans, those come with higher risk because there's a default rate associated with the loans they're making. I would prefer more tech segment revenue. It's good to see it jumping, expected to jump to 20% next year, but still in the most recent quarter, it was slower than the business's growth overall. Moving on, they noted that personal loan originations grew 31% year over year to 3.2 billion, while student loan originations grew 95% and home loan originations increased 193%. That was great to see. I've been saying for SoFi for the longest time, they need to make more student loans and more home loans. Those loans come with lower default rates compared to personal loans, but the vast majority of SoFi's business has been personal loans, the riskiest type of loans. You can see here in the most recent quarter, 3.2 billion was personal loans, 790 billion was student loans, and 300 million was home loans. So combined, student loan and home loan was not even half of what they did in personal loans. 3.2 billion compared to 790 million for student loans. That's only 1/4 of that. And then 309 million for home loans. That's less than 1/10 of the personal loans. And personal loans are the riskiest type of loans. When you're in trouble as a consumer, the first loans you will default on is personal loans. Your last loan that you will default on is your home loan, because you don't want to be evicted. If you don't pay your personal loan, your credit score will drop and you will find it hard to get new loans, but you won't risk losing your home or losing your car. You'll just have a lower credit score, and that's why default rates are higher for personal loans. So as I mentioned, SoFi is spending aggressively for its growth. Financial services net revenue grew by 115% year over year. But look at this explanation here. The credit card and investment business are still in heavy investment mode with losses of over 100 million annually on a run rate basis. So this 115% growth is not organic growth. It's not just customer demand is so high that growth is soaring. That's not the case. SoFi is investing in this growth. That means incentives, promotions, sales, marketing, advertising, everything that goes into it to try to generate that growth, to try and generate that demand. And who knows where the growth rate would be if SoFi was not spending so aggressively to generate that growth. So for me, it's less meaningful when a company grows revenue while spending so aggressively on it. The good news for SoFi investors is that SoFi is targeting very high credit score borrowers, a median FICO of 744. That means those customers that come into SoFi, they're available to pitch several products, investment products, loan products, and all of which, because now with the higher credit score, you're less likely to default. You're more interested in the various financial products that SoFi offers. You have more money to spend, you have more money to invest, and all of that makes you a better value customer for SoFi. So given everything we covered, why did the stock price fluctuate the way it did following earnings? You could see in the last month, here is where SoFi reported earnings. The stock price jumped close to $10 per share, and then it's come back down as of this recording back to where it was before the company reported earnings. Well, the initial euphoria on the company's growth was tempered as investors digested where those sources of growth were coming from. The expectations with SoFi management saying that they expect the Federal Reserve to cut interest rates by 4 times this year. And following the company's earnings results, we had a central bank meeting where Chairman Jerome Powell said, we're not really going to hurry to cut interest rates. So those expectations have decreased in the market. All of that has really tempered expectations for SoFi stock, bringing it back down to where it's at. However, at this lower price, it makes for a more attractive investment opportunity for those interested in Sofi stock. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.